What's going on, guys? Alex here, and today I'm answering a common question that I get, and that has to do with the difference between marginal tax rates and effective tax rates. So this is a common point of confusion, so I thought I'd address it just to get the record straight in terms of what the differences are and when you use one versus the other. So to understand marginal tax rates, we need to talk about the tax brackets, right? So when we say marginal, you want to think tax brackets because they are basically one and the same. And in looking at the tax brackets and rates for 2019 here on the Tax Foundation website, we'll see that there are different rates applicable to different tranches or different levels of income. And specifically, we're dealing with taxable income here. So we're not dealing with AGI, adjusted gross income. We're looking at taxable income. That's important. Now, you'll see the different rates here. You'll see the income amounts. So essentially, the 10% rate is applicable to taxable income for single unmarried individuals. This is for individuals filing with a single filing status. You have basically the 10% rate starting from zero all the way up to $9,700 of taxable income. At $9,700, the 12% rate begins, and so on and so forth. And you'll see that as the amount of taxable income goes up, the percentages increase as well. And when we're talking about taxable income, let me add some color to that as well. So if we pull up the Form 1040, I'll give you a better idea of what taxable income is all about. Now, in looking at the 1040 for 2019, we could take a look at the form, and you'll see that right on line 11B, you have taxable income. So that's what we're referring to. That's the key number that helps us determine what's going to apply in terms of the marginal rates and effective rates and so forth. But taxable income really is where it's at, okay? So in going back to the Tax Foundation site, you'll see that the taxable income being referenced here has those different brackets associated with it. So essentially, if you have over $9,700 of taxable income but less than $39,475, then you're looking at the 12% rate being applicable. But you have to remember that the 10% rate is still applicable from $0 to $9,699. Then the 12% rate would be applicable from $9,700 to $39,474. Okay, so each of these levels is still applicable as your income increases, as the taxable income rises. So essentially, let's say you have $100,000 in taxable income. You're still paying 10% from $0 to $9,699, 12% from this amount all the way up to here, 22%. So you have this blended rate. It's like layers of an onion, okay? All of those lower brackets are still applicable to that particular piece of the taxable income, and your marginal rate is the highest bracket that you're in. So if you have a taxable income of $100,000, let's figure out the marginal tax rate. So it's above $84,200, but it's below $160,725. So you would still be in the 24% bracket. So if your taxable income in 2019 as an individual filing single using that filing status, then your marginal tax rate would be 24%. But that doesn't mean that all of your income is being taxed at 24%. This is an important distinction. It's a common point of confusion. It simply means that this is the top tax rate that you're exposed to, being that your taxable income has met or exceeded the $84,200 amount. You still have those lower tax rates being applicable to those different tranches or levels of income beneath that. But marginal is basically saying that this is the highest rate to which you're exposed. So when you hear someone saying, oh, that's going to expose me to the next marginal tax bracket, they may be in a situation where, let's say, they had $150,000 in taxable income, and then they're looking at getting another $20,000 in taxable income. Some of that is going to put them into the 32% bracket. So a portion of that income is going to be taxed at 32% at the federal level. Now, let's take a look at this in a bit more detail by taking a look at the actual tax return. So I have the tax software here, and I think we can add some color to this to make this a little more simple and straightforward. And this is a typical 1040 right now. There's nothing really on it, but the single filing status is important because all these parameters change if your filing status changes, so just keep that in mind. But other than that, let's go in here and let's put in $20,000 in wages. All right, there's nothing else on the return, and see what that does. Now we have this single individual, $20,000 in wages. The standard deduction is $12,200, and we have taxable income. There's that key figure again of $7,800. Okay, so let's just do a little bit of math here. So we talked about looking at the tax brackets that as long as the taxable income, all right, again, taxable income is $7,800. As long as that amount is less than this, where this bracket begins, then we should be taxed at 10%. Should be the marginal rate. Okay, so let's take a look at what the total tax comes out to. So looking at the next page, we see that the tax is $783. But wait a minute, we talked about the fact that this is the 10% rate, but $783 is not 10% of $7,800, which is our taxable income. So if we take a look at that, we have $7,800, or rather let's do $7,800 times 0.1 is $780. So why is this $783? That's because the way the rules are put together, essentially you need to pull up the instructions for Form 1040 and look at these tax tables that are featured in the publication here. And if you look at the taxable income amount that we have being $7,800, you'll see that the total amount of tax being calculated for, let's see here, the single filing status is $783. And the reason the tables are being used here is that if your taxable income is less than $100,000, then these tables would be applicable, and that's where the amount technically comes from. If your taxable income is over $100,000, then there's a different calculation that's used. But that's why this 783 amount is not 780, it's 783. It's a little bit off of what we'd expect, but basically that's the idea. So if we look at the tax rate section here, you'll see that the marginal rate is 10%, and the effective rate is also 10%. So all of that makes sense. The reason they're the same is because there's only one marginal tax bracket at play here, being the 10% bracket. So we'd expect marginal and effective to be the same. But what if the income is higher and you're exposed to multiple layers of marginal tax rates? What does that have to do with the effective rate? Let's take a look. So let's change our income from $20,000 to $100,000. All right, and this is just straight wages. And let's see what that does. So we changed it to $100,000. We still have the standard deduction applicable. So now our taxable income is $87,800. And let me try to make this so you guys could see it. Okay, so $87,800 is the taxable income. So let's look back at our brackets. So which marginal tax bracket are we in? Now in this case, $87,800. We look here. So we've exceeded this threshold for 24%. So, and on top of that, we didn't get up to the 32% bracket. So we're in the 24% bracket. That's the marginal tax rate, is 24% in this example. But now let's take a look at the tax rates here. And you'll see that the marginal rate is indeed 24%. That agrees to what we saw here. But the effective rate is 17.4%. Now, what is the effective rate? The effective rate doesn't take into account directly the tax brackets. It just says, hey, I have this amount of tax that I'm paying versus this amount of taxable income. What is that percentage? And what the effective rate tells you is that per X amount in taxable income, here's how much you can expect to pay in taxes. It's sort of an average, being that it takes into account all those different brackets and sort of averages out the rate. So you don't have to think about the different brackets. You could just say that, oh, I paid 17.4% of my taxable income in taxes. That's one way you can look at it. Whereas the marginal rates are a little bit more complex because you're saying, well, I'm in the 24% marginal tax bracket, but you're not paying 24% on all the income. And this layout here really highlights that, in that the effective rate is lower than the marginal because you have all those lower levels of tax that are applicable that make up your overall tax sandwich or burger, if you will, right? You have all those different layers, and you need them all there to really figure out what your total amount of tax would be. So in taking a look at the effective rate, let's see how that's calculated. So you can look at your own tax return and figure it out by yourself. The first number there is the total tax amount if we wanted to figure out the effective rate. So in this case, if you look at the 1040, you'll see total tax. That's what we're talking about, line 16 in the 2019. Sometimes you change these lines around. Now, we take 15,253, we divide that by the taxable income again, 87,800, and that's 17.37. We can multiply that by 100 to get a nice percentage, but 17.37 is the effective rate, and that is how this amount is being calculated in the tax software. If we take a look right there at 17.4. All right. And really, when you're thinking about marginal tax rates, you want to figure out where they're applicable most. And marginal tax rates are important if you're considering adding X amount of income to your current situation. What's that going to do? And the marginal rates are important there because if you get into a certain tax bracket, any additional income is going to be taxed at that marginal rate until you hit the next bracket. What am I talking about? Let's simplify this. Let's back up a little bit. So let's say we have an even $200,000 in taxable income. Now, you and I are experts at this point. We know that we would be in the which bracket? Take a look. Which bracket? 200,000 taxable income, single filing status? That's right. We'd be in the 32% bracket. Why? Because we exceeded this lower threshold and we are below this threshold where the next tax bracket begins. So we're in the 32% bracket. Now, if we were to add $2,000 in income, because we're already in the 32% bracket, we'd be at $202,000 of taxable income. Then that additional $2,000 would be taxed at 32% because, again, we're still hanging out in this bracket. We're adding income. So every additional dollar before we hit the next bracket is going to be taxed at that marginal rate that we're currently in. So when we talk about, hey, in this year, I have this much income, I'm thinking of taking an IRA distribution, or I'm thinking of doing a Roth conversion, or other things that may add to income, what is that going to do overall? You're probably dealing with the marginal rates because the effective rate isn't really going to tell you the whole story. And you may find an ugly surprise waiting for you if you think that the effective rate is what's going to be applicable to additional income, because it's not. It's going to be the marginal rate that you're in. And you may even get into the next tax bracket. So when people say, oh, that's going to knock me to the next tax bracket, that's what they're talking about. And the fact that the marginal rate is going to step up to whatever that next bracket happens to be. And generally, we want to keep away from the upper tax brackets if possible, but that's what people are talking about when they go, oh man, that's going to put me in the next bracket. That's the marginal tax rates that they're referring to. On the other hand, effective tax rate, it's more applicable in a situation where a client wants to say, hey, how much am I paying in taxes every year overall versus my income? All right. And on that basis, you could basically take any tax return, do the math that we talked about, essentially taking the total tax and dividing that by the taxable income, and that'll give you the effective rate. So if you're looking at just doing an analysis of, hey, how much is my tax expense on the federal level overall? Forget all the different brackets and all the fanciness. I just want to know, for every dollar of taxable income, how much do I pay in federal taxes? And in this situation, it would be the effective tax rate that you consider, not the marginal. two different perspectives, two ways of looking at it. But at the end of the day, if you equate the word marginal to the brackets, you'll be on your way. If you equate effective tax rate with what is the effective cost, or what am I paying in terms of taxes per dollar of taxable income, you'd be using the effective tax rate. So they're both important analysis tools. They're both important planning tools, but you're in for a really ugly surprise if you use effective tax rate when you should be using marginal, or the other way around. That goes for professionals, and that goes for just people that are trying to figure out their tax situation, because I've seen both really screw this up, and it's not a good outcome generally. So with that said, hopefully this was helpful in terms of shedding some light on marginal versus effective tax rates. I do want to say that this is dealing with just plain income here, because we didn't take into account qualified dividend rates and all those other preferential tax rates and self-employment income. It can get pretty complicated there. We're just looking at plain vanilla ordinary income, no capital gains, this, that, the other thing that might be the subject of later videos. But right now, just keeping it really plain and simple. I wanted to differentiate between marginal tax rates and effective tax rates. And I think at this point, if you guys aren't experts at this, just watch this video again and you will be by the end of it. So hopefully this was helpful. And if you got value out of this, feel free to share the video, subscribe to the channel, leave a comment, like the video, do what you guys do. And till next time, thanks for watching.